Something has been quietly happening across the UK buy-to-let market for the last several years that most landlords with just one or two properties are either unaware of or have dismissed as relevant only to large portfolio investors. The number of new buy-to-let mortgages being taken out in limited company names rather than personal names has, in a relatively short period, gone from a minority quirk of professional property investors to the dominant structure for new landlord purchases across the country. In some recent quarters, the majority of new buy-to-let mortgage applications have been submitted through limited companies rather than by individual landlords in their own names. That shift did not happen by accident. It was triggered by a specific set of tax and regulatory changes that have made personal ownership of rental property increasingly expensive for higher-rate taxpayers. And it has accelerated sharply as each subsequent wave of reform has added further costs to the personal ownership structure. To understand the scale of that shift, consider that as recently as 2016, the proportion of new buy-to-let mortgages being taken out via limited companies was a small minority of total completions, predominantly used by professional investors managing large portfolios who would always structured their affairs in a more formally corporate way. Today, that proportion has more than reversed, with limited company applications consistently representing a clear majority of new buy-to-let business at many lenders. That is a fundamental change in the ownership structure of an entire sector of the housing market, achieved not through any deliberate policy choice to corporatize private landlordism, but as the unintended cumulative consequence of a series of tax and regulatory decisions, each aimed at something more specific. I have been tracking the UK property and landlord market for years, and this specific structural shift matters far beyond the landlords who have already made the move, because it is changing who owns the private rented sector, how it is managed, and what the long-term consequences are for tenants, for housing supply, and for the broader property market. In the next few minutes, I'm going to walk you through exactly why this shift is happening, what it means in practice, and what landlords who have not yet considered this route need to understand before they decide whether it applies to their own situation. Let's start with the tax change that triggered everything, because understanding it is essential to understanding everything that followed. Prior to a series of changes phased in between 2017 and 2020, individual landlords could deduct the full cost of mortgage interest from their rental income before calculating their taxable profit, the same way any other business expense would be treated. That deduction was removed for individual landlords, replaced with a basic rate tax credit worth only the basic rate of tax, currently 20%, regardless of the landlord's own marginal tax rate. For a basic rate taxpayer, this change was largely neutral. For a higher rate taxpayer, the impact was severe. A landlord paying 40% income tax who previously offset mortgage interest at 40% against their rental income is now offsetting it at only 20%, effectively paying income tax on a portion of income that never actually reached their pocket because it went directly to their mortgage lender. For landlords with significant mortgage borrowing relative to their rental income, this change has in some cases created a situation where a property that is nominally profitable is generating a tax bill larger than the actual cash profit the landlord receives after paying the mortgage. Red flag number one, and it is the one that has driven the incorporation rush more than any other single factor, is that limited companies do not face this mortgage interest restriction. A limited company can still deduct mortgage interest as a business expense in the ordinary way, paying corporation tax, currently at a lower headline rate than higher rate income tax, on the resulting profit. The difference in tax treatment between a higher rate tax-paying individual landlord and a limited company owning the same property with the same mortgage can, in specific cases, be the difference between a property that makes money and a property that consistently loses it on a cash flow basis, even while the underlying asset is appreciating. For landlords in that position, incorporation is not a lifestyle choice or a tax planning nicety, it is a financial survival decision. Red flag number two, the stamp duty and capital gains tax friction that makes the decision to incorporate much harder for existing landlords than for new purchasers. Moving an existing property portfolio from personal ownership into a limited company structure is not a simple administrative step. It is, in legal terms, a sale and a repurchase, which means it triggers stamp duty on the transfer and potentially capital gains tax on any increase in the property's value since original purchase. For landlords who have owned properties for many years and whose portfolios have appreciated significantly, the tax cost of incorporating an existing portfolio can run into tens of thousands of pounds, or more for larger portfolios, creating an immediate upfront bill that needs to be weighed against the ongoing tax saving the limited company structure would produce. This is why the incorporation trend has been disproportionately driven by new purchasers who face no transfer cost because they are buying directly into the limited company from the outset rather than by existing landlords restructuring portfolios they have held for years. Red flag number 3, the mortgage rate differential between personal and limited company buy-to-let lending. Limited company buy-to-let mortgages are a different product from personal name buy-to-let mortgages, and historically they have carried higher interest rates, reflecting the lender's additional administrative cost and legal complexity of lending to a corporate entity rather than an individual. That rate differential has narrowed meaningfully in recent years as lender competition in the limited company space has intensified, driven by the volume of landlords seeking this structure, but it has not disappeared entirely. And for some borrowers, in some circumstances, the higher mortgage rate in a limited company structure partially offsets the tax saving. Understanding the specific rate differential on the actual mortgage product available in your specific situation is an essential part of the calculation before deciding whether incorporation makes financial sense. Red flag number 4, the additional administrative burden and running costs of operating a limited company. A limited company requires annual accounts prepared and filed at Companies House, a confirmation statement, corporation tax returns, and, if a salary is extracted from the company, payroll administration. These costs are manageable, and for a portfolio of meaningful size, the accounting fees involved are typically small relative to the tax saving. But for a landlord with a single property and a modest rental income, the additional running costs of the limited company structure can represent a meaningful fraction of the total financial benefit, and the administrative requirement is ongoing, not a one-off setup cost. Landlords who have incorporated on the basis of an initial calculation showing a clear benefit need to factor in these annual costs explicitly, rather than treating the company as a free-to-run structure once it has been set up. Red flag number 5, the extraction problem that catches many landlords off guard when they want to access the profits sitting inside their limited company. A limited company pays corporation tax on its profits, but those after-tax profits belong to the company, not to the landlord personally, until they are extracted. Extraction can happen via salary, via dividend, or via a director's loan, each with different tax treatment and different implications. A landlord who extracts profits as a dividend pays dividend tax in addition to the corporation tax already paid on those profits, meaning the total tax paid on income extracted from a limited company as a dividend is, for a higher rate taxpayer, not as dramatically lower as it might initially appear when only the corporate tax rate is considered. The limited company structure is most advantageous when profits are retained within the company and reinvested, typically into additional properties, rather than extracted regularly as personal income, which means it suits some landlord strategies much better than others. Red flag number 6, the impact of these structural changes on the overall supply and character of the private rented sector. As personal ownership has become more expensive and limited company ownership has grown, the overall direction of travel in the landlord market has been toward a smaller number of more professionalized, larger portfolio operators, at the expense of the individual smaller landlord who owns 1 or 2 properties alongside a main career. That trend, which predates the incorporation wave but has been significantly accelerated by it, combined with the Section 21 changes I covered in a previous video on this channel, has changed the composition of who provides private rented housing in England in ways that are likely to continue reshaping the sector over the coming decade. Now, here is the part that connects all of these together. The shift toward limited company ownership is not simply a tax planning story. It is a story about how a series of policy changes, each individually defensible as targeting the specific tax advantages available to leveraged landlords, has collectively changed the economic model of private landlordism in a way that has pushed it toward a corporate professionalized structure that was never explicitly chosen as a policy goal. The government did not set out to corporatize the private rented sector, it set out to limit the tax advantages of leveraged individual landlords, and the unintended consequence of that policy has been the accelerated professionalisation and incorporation of the sector, with consequences for how it operates, how it is managed, and ultimately what it costs tenants that are still working themselves out.
I spoke with a specialist buy-to-let tax advisor who works with landlords across a range of portfolio sizes, and off the record, her view was direct. She said the single most common situation she encounters is a landlord who became aware of the limited company option several years after they had built a personal name portfolio, who is now facing a significant tax cost to transfer that portfolio into a company and trying to work out whether the long-term saving justifies the short-term transfer cost. She said in many cases the calculation is genuinely unclear and depends heavily on the specific portfolio, the specific mortgage rates available, the landlord's other income, and their plans for the portfolio over the next decade, all of which need to be modelled individually rather than estimated from a generic rule of thumb. She said she is particularly concerned about landlords who have incorporated without fully understanding the extraction issue and who are building up profits inside a company structure they have not thought through a withdrawal strategy for, potentially creating a future tax problem that will be more complex to resolve than the original personal ownership situation ever was. She also described a pattern that comes up regularly in her practice, which is landlords who have been told by a well-meaning friend or by a generic online calculator that a limited company will save them a specific amount of tax each year, who have incorporated on the basis of that figure and who have then discovered that their actual saving is considerably smaller once the mortgage rate differential, the accounting costs, and the extraction tax on dividends are all properly factored in. She said the calculation is not wrong in principle. Limited company ownership is genuinely more tax efficient for most higher rate tax-paying landlords with meaningful borrowing, but the margin of advantage is often considerably narrower than the simplified version of the argument suggests, which makes it more important than ever to model the specific numbers for a specific situation rather than assuming that general principle applies cleanly to every individual case.
So what does this mean practically? First, if you are a new landlord or considering a new purchase, the question of whether to buy in a personal name or a limited company should be addressed before the purchase, not after, because the cost of restructuring once you have bought personally is significant. Second, if you are an existing landlord with a personal name portfolio, get a specific individually modelled calculation from a specialist buy-to-let accountant before making any decision about incorporation, because generic rules of thumb are genuinely unreliable in this area, given how much the right answer depends on individual circumstances. Third, understand the extraction question before you incorporate, specifically how you intend to access the profits generated by the company and what the tax treatment of your preferred extraction method actually is, because the tax efficiency of the limited company structure is much greater if profits are retained and reinvested than if they are regularly extracted as personal income. Fourth, factor the full running cost of the limited company structure into your annual financial model for the portfolio rather than treating it as a free-to-run entity once established, because the accounting and filing costs are real and ongoing. Here's how I expect this to develop. The incorporation trend in buy-to-let is structural rather than cyclical, meaning it will continue regardless of what happens to interest rates or property prices, because the tax differential between personal and corporate ownership that drives it is embedded in legislation that shows no sign of being reversed. Expect the limited company buy-to-let mortgage market to continue developing and becoming more competitive as the volume of this business increases, gradually narrowing the rate differential that currently represents the main financial argument against incorporation for some borrowers. And expect the professionalisation of the landlord market to continue as the combination of incorporation, the Section 21 changes, and the broader compliance burden of operating as a landlord increasingly favours scale and professional management over the casual part-time approach that characterized the individual landlord model that dominated the sector for the previous generation.
It is also worth noting that the limited company structure creates its own future complications that are only now beginning to emerge as the first wave of incorporated portfolios matures. When a landlord who owns property in a limited company wishes to exit the sector entirely, they face a different and in some ways more complex tax situation than a personal name landlord selling properties from their own name. Extracting the full value of the portfolio from the company structure, whether through selling the properties and winding up the company or through selling the company's shares themselves, involves tax calculations that are meaningfully more complex than a straightforward capital gains tax calculation on a personally held asset. And the interaction with inheritance tax planning is different too, in ways that require specialist advice at exit that many landlords who incorporated purely to solve an immediate income tax problem have not yet thought about. The uncomfortable truth is that the UK private rented sector is being quietly but fundamentally restructured, not through a deliberate policy choice to that effect, but as the aggregate result of multiple policy decisions, each aimed at something more specific, and the landlords navigating this environment most successfully are the ones who understand which direction that restructuring is running and are positioning their portfolios accordingly, rather than the ones who are still operating on the assumptions that underpinned a market that no longer exists in the form it did even 5 years ago. Whether you're a landlord with 1 property or 10, a potential new entrant to the market, or a tenant trying to understand why your landlord seems to be doing things differently from how they did a few years ago, the incorporation of buy-to-let is one of the most significant, least publicly discussed structural changes running through the UK housing market right now, and its consequences are going to keep revealing themselves for years to come.